It is my belief that things don't just happen by chance, but by proper planning. Do you have a retirement plan or simply have an investment portfolio that can use some fresh ideas? Hi, my name is Mike Ecker, and my podcast is called Investment Choices. In my podcast, I will be speaking with professionals who will be discussing alternative investment ideas that may be a good fit for your financial plans. There is more to investing than just stocks, bonds, and mutual funds. Hi, everybody. It's Mike Ecker. Welcome to my podcast, Investment Choices, other than stocks, bonds, and mutual funds. I am pleased to have with me today James Ray, R-E-A, or Jim, or whatever. He answers to almost anything. James, thanks for being here today. Appreciate it.
My pleasure. Thank you for inviting me.
Okay. James brings to the table 2 decades of experience in both real estate and capital markets. He served as a company spokesman and interface with the equity and real estate as an equity and real estate broker. James has extensive experience in the investment and sales of senior housing, healthcare, multifamily, hotels, restaurants, leisure, and real estate sectors. James currently holds the Florida real estate agent license. He graduated from Florida State University, received a Bachelor of Science in Hospitality, Administration, and Marketing. I can keep going on, but we don't have enough time. Otherwise, we're going to run out just saying how great James is. Good morning.
Thank you. Appreciate that kind introduction.
It's not morning. I guess whoever's listening, it could be morning, it could be afternoon. Before we start, I just want to tell everybody I hope they're safe and sound and practicing social distancing, as my wife and I are. I leave to go to work. She locks me out. I have to beg to get back in, and that's how she practices social distancing. So I actually had to get new knee pads to get back in my house. James, welcome. As you'll find out, I'm not a serious guy. I'm serious when it comes to investments and the time. I just hope everybody is safe and sound. We're in a really stressful time, and we need a little levity. So again, I wasn't trying to make light of the situation. We are in serious times, and I find that alternative investments today is the strongest place to be in other than the stock market, because this is going to be a long recovery. We need growth. We need potential. I don't think the idea of sitting on the sideline with money right now is the way we should be. So I'm trying to bring in individuals who can tell us about different fields that are open, that I feel comfortable with, and educating you, the public, on it. The whole idea of the podcast is to educate. It's not to sell anything. It's to make you aware that there are different kinds of alternative investments out there that you should consider as part of your portfolio, not just stocks, bonds, and mutual funds. So I want to jump in. Jim, one of the fields today that we're talking about, I'm going to be talking about, is senior housing. And you mentioned senior housing, and the eyebrows go up, and that's why we're having a serious problem today. But we also have a shortage of facilities, and that's what I want to talk about. So if you can enlighten us a little about the senior housing as a market in the future, I'd appreciate it.
Yeah, before we talk about the future, I think it's important to give some context to the past. The senior housing of years past is not going to be anything like the senior housing is today and going forward. And what I mean by that is, if you take a national perspective on seniors housing, the average age of communities across the U.S. right now is about 17 years old. It is not prepared for the current market pre-corona, and definitely not prepared post-market. We already had an undersupply. There's a general opinion that there's overdevelopment nationally, but that is far from the case. If you look at a 30-year trend line, inventory is growing historically at about 4.2%. And over the last year, we were way below that 30-year trend line at 2.6%. And it has everything to do with that little Census Bureau letter that came in the mail, the fastest growing cohort in America is not the millennials. It's not the baby boomers. Seniors housing is not a baby boomer business. It's an 85-year-old plus business. And the fastest growing age group in America for the next 10 years, starting this year in 2020 through 2030, is going to be the 85 plus crowd. No other group in Census Bureau data history, going back to the 1900s, will grow as fast as this particular cohort will grow. And that's going to have both a negative implication for the residents, because it's going to mean there's more heads than there are beds, and that's going to increase the cost. But for those that are on the investment side of that, it could have the potential for a positive impact, because we jokingly say getting old is not going to go out of style anytime soon.
So really the baby boomers, who the big part is now, and you hear a lot about baby boomers, are living longer. And because of that situation, we have to look forward and see how we're going to do the housing and senior care for them. I think that sums it up right there.
That is correct. And I want to point out, Michael, that the baby boomers don't even show up as a resident until right at 2030. That's the year the first baby boomer turns 84. That's 10 years from now. So I want to reiterate, we're not talking about the baby boomers at all. We're talking about the 85 plus crowd.
Wow.
So that's, and by the way, this is a female driven business, both from the shopper standpoint, because it's usually the daughters that are shopping for their parents. So note to dad, take care of your daughter, right? She's gonna pick the place for you. But if you go inside of any senior housing facility in the U.S., what you're going to see, statistically speaking, 75% of the 85-year-olds are females. 70% of those females are widows. So it's an 85-year-old female widow as the typical resident. So if you live long enough, every male will have a chance in a senior housing facility. So
that's if the wife lets him.
That's exactly right.
So in other words, the reason there are more women than men is because that's the way it is, right? That's the women tell the men.
That is the way it is.
Looking at the housing today and the facilities where there's been so much concern about the COVID-19 and the deaths, is that changing the way future housing is going to be built in today's market for that?
It is. It is. It definitely is. But let me clarify the perception in the market is that COVID-19, coronavirus, whatever you want to call it, has had a negative impact on seniors housing. I want to back up and point out that, I know me personally, I thought the barber was an essential business that would never close. And lo and behold, I mean, if you look at my hair, I haven't had a haircut in about 2 months, right?
I just had one. I just had one.
That's right. So we all now know very clearly, Michael, who is essential and who is not. Grocery stores are essential. Senior housing is essential. It did not close down, even in the face of coronavirus threat, right? Now, let's go to the opposite end of that spectrum. What you are reading in the newspaper is about nursing homes where people have been infected, where people have unfortunately died. The Ground Zero Exhibit A is that facility that was in Kirkland, Washington, where unfortunately 19 people passed away because of coronavirus. But I do want to point out, again, it's an essential business. That facility is still open, by the way. And why? Because it's essential and because they have nowhere else to go. A lot of companies, however, in the senior housing industry only focus on private pay, where there's not a skilled nursing or nursing bed component. So those facilities have been much, much more resilient than the ones that have introduced the most frail, high acuity residents that stay in nursing beds.
There's actually, if I'm not mistaken, Jim, and just tell me if I'm right, there's actually a continuum of care. It starts with the active adult where they go into I guess it's called living facilities, independent living facilities, and it goes to that. So let's start with that group first and then move through to the end,
yes,
which is the nursing. Okay, so give us a little insight on the first phase of the senior housing. Did you hear me?
So you are correct, and it actually starts with one stage. It starts one stage before that. The adult living communities is, the 55 plus. It's basically apartments for grown adults. Okay, and as you go through that continuum of care, you have an increase in cost and an increase in acuity, right? Or that's a fancy word for need. So you start out where there's no healthcare need whatsoever, only a housing need at the 55 plus adult communities. There's no healthcare component, only a housing component. And the average cost for that on a monthly basis is about $1,400 to $1,500 a month. Then you go to the next stage, which is independent living, where you introduce a healthcare and housing need. The housing component is always there, but now you're introducing a slight healthcare component where you have nurses that are present, but you may not need their services. That is generally about, let's call it $3,000 a month, right? And then you move to the third phase, which is assisted living, where primarily they're helping manage the 2 M's on the healthcare front. To not oversimplify, the 2 M's stand for meals and medication. Whether you have too much, too little, or not at all, either one of those are the two big things that can get people at that stage in trouble, right? And that's usually about $4,500 a month on a national average. The next phase is memory care, Alzheimer's. That's usually about $6,500 a month on a national average. And then the final phase is the nursing, skilled nursing. And by the way, that may not be final because unfortunately you could have a slip and fall where you break a hip and you need to go to the nursing division for 6 months to 9 months to rehab, and then you go back to assisted or independent living. But there are some communities that have all of that under one roof. They're called CCRCs, Continued Care Retirement Communities. But those type of facilities also require a massive upfront deposit of $150,000 to $350,000. And then you have,
house.
Yeah, it really is. And I'm glad you made that comment because those type of facilities typically are impacted by a down economy because if you can't sell your house, then you can't come up with a deposit. Then you have more resilient communities which only require a pay-as-you-go. You don't need to come up with $150 to $350. You just pay month to month on a 1-year lease. Those are typically independent, assisted, memory care, all under one roof. And those are not continued care retirement communities. So that's the big difference. CCRCs require a massive upfront deposit. By the way, they're regulated by typically the state insurance regulatory department. So in Florida, for example, Tallahassee regulates that because you're asking a senior citizen to come up with a sizable, as you said, house deposit. They have financial oversight, whereas the other facilities don't have, the economic impact because you don't need to sell your house, and they don't have the state level government oversight because you're just paying month to month.
Okay.
So
I just want to clarify or ask you a question rather. When you say under one roof, is it like a different wing of the same building? In other words, one is assisted living. Is it the same building or different buildings on the same campus?
Well, generally speaking, the facilities that we see today, the new construction, and we don't call them facilities anymore. That's what they used to call them. We call them communities now. It's more of a hotel model, less of a hospital model. And generally speaking, you will have in most of the modern construction approach, part of the main structure of that community is both independent living and assisted living, and then a totally separate wing or totally separate floor out of sight, out of mind for the memory care division. And it's a very kind of taboo subject, if you will, but a lot of people don't want to see that side of aging, candidly. That's one of the reasons it's separate. The other reason is for safety, because if you have memory loss, a lot of the folks in there are looking for the exit, so to speak, and you have to have dual redundancy, if you will, for the doors and security so they can't slip out and cause harm to themselves. So that Alzheimer's is usually separate from independent living and memory care, either a separate floor or a totally separate wing.
That's one of the saddest things that I've ever seen. I know, unfortunately, people that I know and friends and relatives who have people going in where the memory's starting to go. It's an increase. Uh, it's so frustrating to see a loved one slip away into a different world and you can't communicate. That is the most frustrating part of, I guess, the season senior community. That's, to me, that's heartbreaking. Not that the other cases aren't heartbreaking either, but there's nothing worse than talking to a relative that doesn't recognize you anymore.
Michael, I couldn't agree more. It always touches my heart when I walk through the facilities that I've frequented and go to that wing, if you will, or that floor. But you know, I always leave with a warm feeling when I walk away as you look at the dignity that is provided in those type of communities for aging, being around people your own age in a professional setting, and you just don't get that. I think the biggest takeaway that we all have that has been put front and center, if there is any benefit from COVID-19, it's that we all have come to the realization that educating your kids from home, working from home, or your parents and loved ones receiving healthcare and housing as they age from home is a short-term solution. It's not a long-term solution. It has everything to do with dignity in aging and social and psychological benefits of being in a community where you have people that care for you and you have interaction with folks from your own age with similar life experiences. And you
Like
just
I said
don't get that.
before, this COVID-19 is actually going to change the way we think about a lot of things, how we socialize, how we greet people, looking around. And, you know, years ago, somebody had sneezed or you're in a thing and they've got a cold or a virus. You know, now you're going to stand back and take a second look at if you want to be with that person or not. I wanted to get into the area, Jim, more of the construction and how this is going in and the building of these facilities as an investment alternative. Where do you see this going right now in the growth? How are we producing a lot, or we're not producing enough, in your opinion?
We're definitely not producing enough. To simplify the math, okay? It's a 4-to-1 imbalance. We need to be building 4 units and we're only building 1. Based on this previously referenced, I call it a silver tsunami of age, growth, and demand. And by the way, people that can actually afford, there's many more heads. That's a 6-to-1 imbalance. There's 6 heads and only 1 bed, and 6 heads that can afford, by the way. There's many more heads that can afford, but there's 6 who can afford and only 1 bed. That's why the cost to the resident is going up at a 7% annualized rate. And it's going up not only because of the demand, but because of the low supply delivery. We need to be building about 95,000 units a year, and we're only building about 25,000 units a year. That's why I say that 4-to-1 imbalance. We need to build 4, we're only building 1. That's going to get worse. That isn't going to get better. But if you're on the investment side of that, that may not be a bad place to be.
Well, are the homes or the units that you're building in the different categories, are they different today because of COVID? Is there a different realization in the construction now, understanding what we've had to go through recently to what the anticipation is for the future?
I think the generalized statement I could make with regard to that, because it's a process in place, but I think the big difference between the average age facility of 17 years old versus the new deliveries that are out there is just the amount of common space. You know, the wider living quarters, if you will, the gathering areas are much larger, much more sizable. You know, again, I go back to this idea that we're talking about hotel of today versus hospital of yesterday. That's the biggest difference. Community versus clinic, if you will. Whatever you would think about having in a really nice hotel, you know, a lobby where you walk into the place, a restaurant, multiple restaurants, a bar, laundry services, housekeeping, a spa, a gym, a pool, a shuttle bus service. All of that is typically under one roof. especially in the newer facilities. And again, you have a larger space as well, which is definitely going to be needed in this new social distancing environment we find ourselves in.
As I pointed out before in the past of my podcast, the looking into these homes is not usually the senior. It's the children. The children are really involved today where their parents are going to go, the facility that they're looking at, and they're looking for the newer facility. They're looking for something that they can feel comfortable that their parent is going to go into.
Yes.
So as far as the building is an investment, again, you can look at the nursing homes and different facilities that we have that are existing where that's one type of investment. But the building of these facilities is so necessary that I think this investment is something for the future. In other words, you're not going to be investing in this kind of investment for an income per se immediately. This is something you're looking to build and go in the future on a return once these units are built and sold. I guess that leads me to my next question, Jim, is when you build these facilities, how long do these facilities take to start having people come in and fill up? It seems like the demand isn't there. And to me, it's like as soon as it's built, it should be filled the next day, but I know that's not real. So what is usually the format when a unit or complex, or it's not a complex, what did you call it, a community? When these communities are built, how long does it take to fill it up as
Correct.
an investor looking at their investment?
So generally speaking, the timelines, and again, it differs, company by company, but I'm going to give a general rule of thumb. It takes about 1.5 years to build to completion for the average facility, okay? It takes about 2 years to lease it up. And when I say lease up, you never want to be 100% occupancy in a multi-tenant investment, whether, that's retail or housing. You always want to be low to mid 90%. You want some vacancy so you can update the unit and raise the rent, right? So generally once you reach that, it's about 2 years out. Now, again, I'm going to go back to this idea, and you just referenced it. If the daughter is taking her mom and dad around the community to shop and look at the options, the majority of options that are out there are facilities that are outdated. And quite frankly, when you walk into the lobby, the smell, it has a unique and smell to it, right?
Yes.
Whereas you go into a new facility, it smells like a hotel, not like a hospital. They have a immediate marketing advantage. They typically also have an immediate advantage because they're newer and because typically the older facilities are already full and there's a wait list. So when a new facility opens up, they tend to be able to lease up at a fairly good rate, right? They don't have the delay that the older facilities have. And new facilities open up also typically create a challenge for the older facilities, not just from taking business, but taking employees as well, because a lot of the nurses, a lot of the executive staff, a lot of the marketing and leasing team says, hey, there's a new kid in town. Maybe I can get paid more over here and it's a new place. Let me go try this out. And so that has created a major issue for the older facilities and their ability to not only maintain their occupancy when a new facility opens up, but maintain their talent.
Okay, with any investment, as we're talking, because I happen to think that this particular area is a good investment for growth, but as we mentioned, good things, what are some of the risks an investor might have to look at when they go into something like that? Nobody wants to invest and the money's just going to be tied up and they're never going to get a return. So
correct.
What are some of the risk factors involved?
Listen, whether you do this yourself, okay, you go out and buy your own hard asset direct investment into real estate, or whether you do it with an investment company. The single biggest risk, as far as I'm concerned, is the illiquidity. So you need to make sure if you're going into an investment that's illiquid, whether it's you doing it yourself because you've been emboldened by HGTV, or whether you're doing it with an investment company, you need 2 E's. The first E is you need to make sure either you or the company you're doing business with has experience in the space. They know what they're doing. They have banking relationships, because real estate, whether you do it yourself or somebody else does it, is typically a levered investment, okay? But also experience developing, managing, operating. The second E, experience, is important in an illiquid investment, but the second E is even more important. You just mentioned it. If you're going to be in an illiquid investment, you need to know where the exit is. How am I going to get out of this? It's more important to know where the exit is before you enter an investment, especially one that's illiquid. Again, whether you're buying your own rental property or commercial investment property, or whether you're leaving those decisions and expertise up to an investment company. Either way, you need experience and you need to know where the exit doors are. And hopefully there's more than one door.
That would be good. I just want to preface to everybody that's listening that these are suggestions, and really you have to check with your financial consultant, your team, your CPA, etc., before you make any decision to make sure it's right for you. There are different things. What's your risk tolerance? Qualified investor that you need to be in these kind of investments. What does qualified mean? It means that you have a certain income, $1 million or more. It means that you have an income of $200,000, possibly or more. If you're a married couple, $300,000. But you don't go into any investment without getting the financial advice. If your financial advisor does not have a portfolio of alternative investments, I guess the first question is why? Are they diversified and they're diversifying your investment dollars, or are they just putting you in stocks, bonds, and mutual funds because they don't have access to alternative investments? Situation in today's market, if you have all your eggs in one basket, you're going to be sitting there for a couple of years. So again, these are just ideas for you to look into. They're alternative investments. If your financial advisor doesn't have it and he's not part of a team that can get it for you, give me a call. We can direct you to the right person. Jim, I want to thank you. I mean, this is really informative, and it's an area that I'm really keen on because of the need in this particular area for the housing. It's, when you look at student housing for college and you say there's not enough student housing, there's definitely not enough housing for our seniors in the coming future. So this, to me, is really great. Is there anything that you want to add at the end, Jim?
I'm going to couple up to what you just said. Look, what we are so encouraged about, there's so many investments that you can be in. And I don't say this to be a cheese ball. I genuinely mean this. There's so many investments that you can be in that have a purse string component to it, if you will. It's all about the math and the numbers and the return and the risk. But what encourages us in this industry is this has a heartstring component to it as well. That's very, very important, I think, to society in general. You're talking about taking care of those who have taken care of you. And what is more important than that? I think that is ultimately what our business is about. I said it earlier, aging with dignity is very, very important. Aging with some level of independence. Most senior citizens, we find, don't want to be relying upon their kids. They want to have some dignity and some independence. And this sector of real estate provides that to those that have done their job taking care of their kids and grandkids. And now it's time that they are taken care of.
Well, it comes down to one of my beliefs, Jim, and I'm old school, that it's all about family. Family is super important. It's frustrating now that I can't be with my grandkids and my kids, and I'm sitting here and I've got to talk to them or Zoom them, so to speak. So it is kind of frustrating right now. I want to thank everybody for listening. It's really important to understand, in my opinion, that money on the side right now should be working for you for growth. You have to know what your risk factor, your time factors are, where you're going, what your plans are. Diversification is important. And that's why my podcast is called Investment Choices Other Than Stocks, Bonds, and Mutual Funds. I thank everybody for listening. It would be great if you could tell a friend to listen to my podcast so they get educated. Again, we're not selling anything, we're educating. Jim, thanks a lot. Stay safe, my friend. I really appreciate the time.
Thank you. My pleasure. Have
Super.
a great day.
Thank you for listening. Remember, things just don't happen when it comes to your financial future. This is Mike Eckert, and you've been listening to Investment Choices.